Okay, HDFC Bank, that came out with numbers over the weekend. So let's take it across to Siddharth Purohit and analyze these numbers. Siddharth, hi. Morning. Steady as always. The profit has grown in line with estimates. Slippages, though, have inched higher. What has been your first take on the numbers? And would these numbers then make you revise your targets at a time when other banks are grappling with growth?
Yeah, very good morning. In fact, this quarter around, again, HDFC's headline number has been more or less in line with expected front. 20% bottom line growth is what they have been delivering, and this quarter was no unusual. So on bottom line front, very much at place. Loan growth, if you look at roughly 24%, that is a little higher than what they did in Q2 of this year. So loan growth also has been fairly decent, 24% each on the wholesale as well as retail side. If you look at their prime growth driver, like the personal loans and credit card, they have also grown pretty strong, as well as the home loan segment. So on growth front, there is no complaint as such. What has probably changed a little bit during this quarter, the 2 points I would like to highlight is that, slippages has been on a little higher side, though it's not very alarming, roughly around 4,000 crores for this quarter. So that is on a little higher side. And if you look at even the NPA numbers, though it is still one of the best in the industry, little bit of rise in GNPA, roughly 5 basis point to 1.38 at GNPA. But simultaneously, what has happened is that the bank has taken adequate provisions during this quarter and has kept their provisioning PCR under check. So PCR continues to be high. So probably good numbers on headline front. There is little bit of worry on the asset quality during this quarter, and the commentary also suggests that maybe coming quarters we might see some more stress on the agri loan portfolio. But the good news is that their bread and butter, the retail portfolio, and particularly the corporate segment, whatever working capital they do, there is not much of stress. So only some segment has witnessed a blip, or else fairly good numbers during this quarter.
What about your assessment on the way the employee cost is moving? Because the USP for HDFC Bank has been that they've managed to cut the employee cost a lot.
In fact, I don't think that on the costing front, cost to income ratio, if you look at HDFC Bank, is one of the best placed. I don't see much reduction over there. Probably it will not go up substantially because they have been adopting a lot of technology, but I don't see much improvement or maybe much reduction or maybe scope for reduction in cost to income ratio. What has happened during this quarter, if you see, the other income has gone up substantially. That's why their cost to income ratio looks under control. But in absolute terms, yes, that has gone up. One part rather I would like to highlight more than cost is that, the cost of fund. The cost of fund has rather gone up, I would say. Because if you look at on a consistent basis, their CASA ratio has been under pressure. Like a lot of money from their own accounts, from the savings accounts, has moved to the term deposit side. So their cost of fund has gone up, and simultaneously there is a shift in their CASA ratio. It has gone down. So it would be more important to observe the CASA ratio than absolute employee cost, because as long as they are able to contain the cost to income ratio at current level, there will not be a point of worry.
We'll leave it at that. Thanks very much for joining us with that quick review on HDFC Bank and what the stock may do later today.